Hello everyone and welcome to your Glassnode video report for week 25, 2022. So what we're looking at today is the market as it falls down below the 2017 all-time high of 20,000 over the weekend. Now this was a major sell-off that was driven by a number of factors. It was a deleveraging both on-chain and off-chain. We saw that entities are suddenly coming into financial pressure where they're actually insolvent in some regards. We're seeing miners coming into some form of capitulation. And we're seeing hodlers and long-term holders also coming into stress. So as prices fall down at this magnitude, you really do start to see those cracks forming in those financial positions. So what we're going to focus on today is a bit of an assessment of the profitability of the network, what actually drove this sell-off. Generally speaking, we see these cyclical patterns where the market gets into a certain level of profitability, and that's what we've been terming a pain threshold. It's this point in time when the market simply can't withstand that level of drawdown any further. And this is an effect that doesn't just happen to Bitcoin. This is something that happens through all market cycles. Eventually, bear markets finally bottom out when there's an exhaustion of sellers and there's just simply no one left to distribute. So what we're going to look at today is the all-time high in investors realizing on-chain losses. This is the amount of value that was lost based on when the coins were last spent, when they were accumulated on-chain, and then what they've currently sold at these lower prices. We also saw that there's been this stress coming into both miner and hodler markets, and we're really going to spend some time looking at the miners in particular because this is a very interesting topic of which we have a number of tools we can use to really assess this. And we're also going to look at the long-term holders who distributed about 178,000 BTC over the course of the last few weeks, which is significant, but it is still just 1.3% of their total holding. So just trying to contextualize these things. So as always, please do give us a rate, a share, and subscribe. And if you did miss it, we released a paper on the Ethereum DeFi ecosystem on Friday, which is really looking at the amount of deleveraging that's happened. So if you did miss that, you'll find that article in the show notes below. And let's get started with our analysis. So here we are in our week 25 dashboard, and what we've seen is this dramatic sell-off. You can see here that we've essentially traded down from the 46,000s all the way down to a low of about 17,600. Now, this is a very interesting number we're going to touch on very shortly, looking at the cost of production. It's quite interesting that we bounced off 17,600, and we're going to explore why that is. Now, this drawdown continues to get more severe. We got down to minus 75% during this drawdown. And what's quite interesting is when we look at the long-term holder profile, we've actually seen that some long-term holders managed to realize 75% losses. Now, what that actually means is that some long-term holders bought the top up at 69,000 and then sold the bottom down at 17,600. So even those long-term holders are in that position where they can buy the top and sell the bottom. This does happen. Now, speaking of buying the top, selling the bottom, what we're looking for here is the realized loss. Now, this is one of my personal favorite metrics alongside realized profit because it's really one of the most raw metrics that just shows us the amount of pain that's been actualized. Now, we'll often talk about unrealized and realized profit and loss. So unrealized is the coin value that people still hold. This is the amount of profit or loss that's still in the system. If those coins were spent, they will realize that profit and loss. So the way that we calculate this, we look at when a coin was accumulated on chain. This is our best estimate as to the cost basis. And if someone bought a coin up here in the 50s or the 60,000s and then sells it down here at the 20 or the 18,000s, they're going to realize a loss. Now, what we can see here is this is an all-time high. We had about 4 days or 3 days where we had these extremely high, over $2.4 billion in a single day. And when we look at this over the span of a couple of days, there was over $7 billion realized just during that sell-off. So this 3-day period over the weekend, we've seen about $7.5 billion in realized losses come to fruition. So this is really showing that we have actualized a great deal of this pain. Eventually, people reach a point where they simply cannot hold the coins underwater anymore, and they do spend them, they do sell them. And we did see inflows to exchanges, but we simultaneously saw outflows. We actually didn't see a net change in overall exchange balances. Those who were spending those coins and sending them to the exchange is really our focus here. We're looking at people who realize those losses and those profits. Now, this is where we look at the unrealized portion. So that's the realization. We saw that people actually capitulated and sold their coins at a loss from a cheaper price than when they accumulated them. Now, what we have plotted out here is what we call the unrealized component. This is the MVRV, and we've got it for different components. So the MVRV stands for market value divided by realized value, market value to realized value ratio. And this is looking at the spot price. So what are the coins worth right now versus what did that particular cohort actually pay for them? Now we have three curves here. We have our long-term holders in blue, we have our full market in orange, and we have our short-term holders in pink. Now we've also got a green line here, which is basically a level of 1. This is showing that that particular cohort is at their cost basis. If it's below 1, it means that that particular cohort is underwater or currently holds coins at a loss. And you can see here that long-term holders in blue, they have much, much higher unrealized profits at the top of bull markets. They've held their coins much longer, they bought them much cheaper, so their profit is much higher. The real market, so if you look at the average of the entire market, it's lower than long-term holders, but it's also higher than short-term holders, because short-term holders typically are that, well, they are 5 months. They've held their coins much, much sooner. They've bought their coins closer to the current price. So you can actually see the 3 different tiers of profit and loss here. Now, what you can also see here is these red barred zones. This is essentially where all 3 of these models, the long-term, the short-term, and the aggregate market, are all underwater. You can see that 2015, it pretty much caught the bottom lows of the bear. We saw the same back here in 2012 and here in 2018 and March 2020. These are periods of time where the entire market has fallen underwater. Every single coin on average held by those cohorts is essentially under its cost basis. Now, you may be able to see that over the course of the weekend, we in fact printed a red bar. We've essentially seen the market plunge below the realized price of every single cohort. Now, again, as we say often with these metrics, it doesn't necessarily mean that the bottom will be put in at this point in time. As you can see here, it took some time for this to play out, the order of months here in 2018, and it was a year back in 2015. March 2020 was about 3 days. So we really don't know how exactly this is going to play out, but what we are seeing is that we're at that pain threshold, which historically correlates with bear market lows. The market and human beings are predictable, even though markets are not predictable. And eventually people get to a level of financial stress where they simply can't hold their position anymore. And when they capitulate, there's no more sellers. And this is the process that bear markets go through to hammer out floors. On a very similar note, we now bring in, again, this is the supply profitability, looking at supply, addresses, UTXOs, and long-term holder supply. So you can see that these 3 curves tend to trade fairly similarly. They tend to move up and down with bulls and bears. They obviously hit a value of 1 during all-time highs because by definition, every single address, coin, and supply is in profit. And you can see that where we are currently trading at the moment, we're down around the 55 to 60% profitability. Now, this is coincident. This is quite close to what we had back here in March 2020. It's not quite as bad as we had back here in 2018, but we are down around these pain thresholds that typically start seeing the market fully capitulating. So we are at that pain threshold. Over time, we do expect some of these metrics, the floor of these models, to actually climb. This is because we have lost coins, we have coins in deep cold storage, we have more conviction in some investors. So we do tend to see the flaws of these particular models increasing. Nevertheless, when we look at all of this in context, we are now in a very, very similar state of profitability or an equivalent level of financial pain that we have seen at bear market lows in the past. So again, we're starting to find that confluence and that unspent behavior that we are in those pain thresholds that typically signify bearish trends or the lows of bearish trends. Now, the other thing we're going to look at now is transition to the miners. We're going to look at miners and long-term holders. These both represent 2 of arguably the strongest bulls in the Bitcoin space. Miners, because they have to invest an extraordinary amount in hardware and logistics to actually run their operations. It's a seriously cutthroat business. And long-term holders, who are those who've actually literally held their coins for an extended period of time. So we're mapping out these 2 strong hands. Now, what we've seen, again, we're going to look at this in terms of the realized or the actualized behavior. What are we actually seeing happening on chain? And then we're going to look at the unrealized, which are kind of the implied models. We imply that there's stress, but then we have to actually observe that that stress is manifesting in their actions. So the first thing we're going to look at is the difficulty regression model. I mentioned 17,600 at the start and why that's important. Now, we can run what's called a regression model or a log-log regression model. This is similar. You may have seen the stock-to-flow model. It's the same technique, but in this instance, we're applying it to difficulty. Now, this has an extremely high correlation to price, and the reason for this is because we have difficulty will rise when miners introduce more hardware. It will also decline when the market gets stressed and prices fall and the miners must switch off their hardware. So it's kind of mapping out the price of mining. So when we run a regression model, what we actually calculate or we estimate is more or less with all of the machines, which are of different fleets, different manufacturers, installed at different times, different power costs, all of the variabilities in the mining space globally. It all gets distilled down into one number: difficulty. So when we run this regression model between market cap and difficulty, we end up with a very, very strong match, basically saying that the two of them can help describe each other. And what we see is that the all-in price, our best estimate as to what the price to mine on average a Bitcoin is $17,600. And isn't it interesting that the price essentially bounced off that level? This is really coming back to Bitcoin being a digital commodity. And for those who are familiar with the commodity space, we typically see assets, whether it's gold, whether it's copper or timber, they tend to return back to their cost of production. This is one of these trends that we see play out year over year. So over time, we see that commodities go through their booms and their busts, but they tend to oscillate around their cost of production, which we can see Bitcoin has done over the last period of time. So coming down to revisit 17,600 makes sense within that context. So with prices coming down towards the cost of production, remember, this is the average price. Some miners will be doing better than that, mining coin that's cheaper than 17.6. And there's going to be others who are over leveraged, bought capital at the wrong time, or have more expensive power that are mining above that level. So the fact that we came down and touched our cost of production really suggests that there's going to be some miners who are in a stressed position. So now we move into, are we actually seeing that stress? And if we look at the hash ribbons, this is looking at when a fast moving average, the green 30-day, cuts below the blue, which is a slower moving average. This typically signifies the hash rate's coming offline in a significant way and has historically aligned with periods of financial stress for miners. So we saw it at the halving event back here where their income literally got chopped in half. We saw it in March 2020 where the market chopped their income in half. In the end of the 2018 bear. And you can see that during this course of this sell-off, we in fact triggered one of these hash rate ribbon inversions. So it's showing that hash rate is starting to come out of the market, which is an observation that you can't fake. When we see this actually occurring, blocks are slowing down. That means that there's less hash rate solving the same difficulty puzzle. So we are seeing that hash rate's coming offline. Now we can actually bolster this argument using two metrics. In the orange here, we have what was called the Puell multiple. This is looking at the average amount of income coming in per day and comparing it to the yearly average. So in other words, if miners have been mining $60 million a day in total over the last year, and they're currently earning $10 million, they're earning 1/6 of their yearly income. So the Puell multiple obviously oscillate around that particular level, and it reaches these very low values below 0.6, meaning they're earning 40% less than their yearly average. This is what we classify as the threshold. This is where miners typically start to get into a stressed condition. Now we can see this here in 2015 at the lows. This is when miners were in that high degree of stress. Same here in 2018 when we got to the lows. Following March 2020, during the halving event. So all of these are mapping out when their income is severely stressed. We can see it here in the Great Migration back in July 2021. And you can see that over the last couple of weeks, we have again been triggering that very, very low level of the Puell multiple. Now, just to add a third and final piece of evidence to this, we have in the background this purple curve, which is our difficulty ribbon compression. Now, this is very similar to the hash rate ribbon, but turning it into an oscillator. So when we get a compression of difficulty, which is again, this observed behavior that rigs are coming offline, we are actually seeing that miners have to turn off some of their machines in order to stay operational. It's costing them more to run the machine than they're earning in Bitcoin. So these brown zones that we're seeing here is essentially when we have both the Puell multiple at a low, signifying that their income is stressed, and we have difficulty ribbon compression. So the combination of actual income stress and an observed shutdown of machines, coupled with the hash ribbon, really suggests that miners are in a stressed position and they are starting to capitulate. And we can actually see this playing out in their behavior. This is the miner net position change. They have been spending between 5,000 to 8,000 BTC per month over the last couple of weeks. So we've actually seen that they are spending their coin. So not only have we inferred that they're having stress, we've seen that their hash rate is coming offline, but they're also spending their treasury to stay in business. So it's really helping us map out these realities of what's going on in the mining space. Now, it has slowed down recently. You've seen that miners have started adding a little bit to their balance, but remember that their incomes remain very stressed. This doesn't necessarily mean a trend reversal. We do have to be careful that miners may well still be in a period of stress, especially if this persists for a long period of time. Now, the last thing we're going to look at is the long-term holders. Again, these are those investors who've held their coins for 5 months. And what we've seen, you can see in our long-term holder supply up here, that this decline over the last couple of weeks, it may look small in scale, but that's only because they hold 13.5 million BTC. This tiny little dip that you can see here is actually 178,000 BTC that have been spent by this cohort. It's brought it back to levels here in September when it was actually on the way up, climbing higher. And we've got our long-term holder MVRV, which is really, we've looked at this before, but this is in more detail. You can see that we've now entered that zone where they are underwater on aggregate on their coin supply. So when we actually map all of this together, we can see that those long-term holders are under their cost basis. They've held their coins for a long time. And thus, now that they're actually under financial pain, this really explains why we're seeing that 178,000 BTC being spent. Now we can confirm this by looking at our revived supply older than 1 year. Now, long-term holders will be included in this, even though their cutoff is 5 months. We're looking at this in 1 year because it kind of provides us with a bit of a snapshot of those longer term holders, right? These 1 year plus investors. And we can see that there was an acceleration of BTC being spent. 20,000 to 36,000 BTC per day during the course of this sell-off. So you can see now where that sell pressure was coming from. We were actually, I mean, it comes from a lot of places, but it was miners and it was long-term holders who were all experiencing a major flush out. They're seeing that their investment has gone underwater. They're under their cost basis. All of their profitability has declined, and they're now in a position where they have to liquidate. They feel the need to actually exit their positions. Now we can also then look at our long-term holder accumulation and distribution. Now there's 2 observations that we can take from this one. The first one is that we have these very, very large declines in long-term holder spending behavior. See these large red prints? This is showing that their supply, their overall balance is declining at a very, very significant rate. This is talking about 6%, 10%, almost 10% of their balance being released in a single month. But note how these tend to occur around bull markets. We saw it here in 2013 twice, the 2012 peak. We saw it at the end of the 2017 run, and we saw it up into the January, February highs of 2021. So isn't it interesting that long-term holders actually liquidate their supply, 6% to 10% of their supply in bull markets? This is where we get the observation that long-term holders are typically the smart money. They're buying in the bear and they're liquidating in the bull. That's where the majority of their sell side comes from. And this is why you get these big declines during bulls of long-term holder supply. So it may be a bit counterintuitive, but what we actually see is that long-term holder supply, which is a good metric, you want to see more people holding BTC for the long term. If we're looking at price, when you see them actually distributing, isn't it ironic that it actually happens when price is rallying the hardest? Now, the other observation here is these much smaller spends. So we've seen that there's a little bit going on. It's 0.05% of their supply has been spent over the last month. And we can see that this is actually occurring during bear markets, typically towards the lows. Now, this describes 2 things. The first one is that when we get to these bear market lows, and we saw a lot of it this week, a lot of the sell side is actually what we call forced sellers. They're people who may not actually want to sell their Bitcoin. Like miners, their mandate is to try and hodl as much as they can. Long-term holders are always trying to accumulate. However, sometimes the market creates so much stress that they don't sell what they need, what they want to sell. They're selling what they have to sell. They have to meet margin calls. They have to cover their debt obligations. They don't know how much worse things are going to get. And that uncertainty means that they must sell a portion of their balance because they have to, not because they want to. So we're seeing here that this looks somewhat like a capitulation style event where we're getting these flush outs during periods of high volatility. But notice how it is much smaller than during bull markets. So whilst they are selling what they have to, not what they need, they're selling what they need to sell, not what they want to sell, we're seeing this occur at a similar rate to previous bear market lows. The volatility has been enough for them to flush out, but simultaneously, they're not exiting their whole position. A lot of those long-term holders are more or less unfazed. If they were completely scared, this thing would continue to trend lower. Now, this is a metric we will be paying attention to over coming weeks, because if it does continue to trend lower, that's obviously not a great sign. If it does start to plateau and smooth out, that would be a more constructive sign. So we're very much in that observational phase at the moment, seeing how these metrics evolve over the coming weeks. So thank you for tuning in for this session. Hopefully that put a bit of context into what's really going on. We're getting into this part of the market cycle where we're entering capitulation phases. People are selling because they have to. We're seeing that miners are under an immense amount of income stress, and the metric of the week is this miner capitulation tracking. You will see this inside the description below. This is a really powerful metric that anyone with an advanced Glassnode subscription can look at. And what we're looking for here is the confluence between both pure multiple and the actual ribbon compression. So what we want to see is this actually start to reverse, income start to increase, and miners have to switch off less of their devices. Until that happens, the probability that miners and even long-term holders are going to continue to be stressed is likely to continue. So thanks for tuning in. Hopefully that was useful, and I will see you in the next one. Cheers.